Hey everybody, it's Erik, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories by Village Global. I'm here today with a very special guest, Michael Kim, founder of Cendana Capital. Michael, welcome to the podcast.
Thanks, great to be here.
So Michael, why don't you give a brief background into what is Cendana, why you started it, and where you are today?
Okay, so I simply put, we're an investment management firm, and we are investing in the seed venture capital ecosystem. So what I mean by that is seed funds in the U.S. as well as outside the U.S., as well as co-investments into portfolio companies from our fund managers. And so I started this in 2010. It took me a while to raise the first fund. We can talk all about the fun aspects of fundraising. But, I think right now we're positioned pretty well to be one of the first calls as an LP for someone who's looking to raise a seed fund. And I would say that we were pretty early I wouldn't say we were first, but we were pretty early in identifying the space. And this is all we do. So that really helps with our market position.
And what was that gap that you identified and wanted to capture?
Well, if you look at venture sort of in a broader arc, in the late 90s, the standard deal in software was 5-on-5, right? Two Sand Hill Road firms, each doing 2.5 at a 5 pre. They're getting, a quarter of the company. And, the entrepreneur would have to raise $5 million to do a software company because they were buying Sun Microsystem servers. They're paying software licenses. So, literally it's an order of magnitude cheaper now, right? $500K you can get going, primarily because of AWS and the cloud, open source software. And, what really drove, I think, the proliferation of seed funds, or at least created that opportunity, is that the best firms like Sequoia, Accel, Benchmark, Greylock, they all became much, much bigger. And then at the same time, it was a lot cheaper to start a company. So that created that gap. And then in the early 2000s, you saw firms like Union Square, Foundry, and True focus on smaller Series A. I guess you could even argue that they were seed at one point. And then in the mid-2000s, first round capital, late 2000s, you had actually super angels like Jeff Clavier, and you never hear super angels anymore.
Yeah,
but
why not? Because everyone's an angel?
Well, everyone's an angel, but super angels, I think I would have defined it as someone who's doing investing full time with their own money. But I think with the proliferation of seed funds, part of that is because institutional LPs wanted to start deploying capital. So instead of being a super angel, the super angels actually went out and raised outside capital.
They went pro, so to speak.
Yeah, so those two big dynamics, a lot cheaper to start a company, best firms becoming really big, created this gap where all these smaller firms started filling it.
And you've been doing this for, since almost a decade. How has your thesis evolved, or has it stayed the same throughout?
Well, I can talk about what has stayed the same. Even when I started, one of the guiding principles, and we can talk about this in terms of how we evaluate all the opportunities set, we've always looked for firms that lead their investments. So if you just use that one filter, they talk about 700-800 seed funds in the U.S. If you apply that one filter to those firms, probably 5 to 7% can actually lead a deal. They have the credibility to lead the deal. The rest are just following in a syndicate, or pejoratively put. Some people will say it's spraying and praying. So I think if you maintain that one filter from the get-go, which I think we have, you would have identified some pretty outstanding fund managers. I think certainly the round sizes at seed have gotten bigger, and certainly seed in itself, writ large, has sort of titrated into 3 buckets: pre-seed, seed, and then seed extension. It's kind of crazy. So by the time you're raising a Series A, it could have been 3 or 4 rounds. So seed rounds getting bigger, but what hasn't really changed too much is the dilution that founders are taking when they do the seed round. So they, it's kind of fluctuating between 20 to 25. We can talk about that too, but I would say that, it's become a lot more seed funds, titrating 3 buckets, round sizes are bigger, dilution about the same, and, certainly there's a lot more.
You've had a point of view on portfolio construction.
Yes.
So talk about how you do that.
It's super important to us. In fact, it's almost shocking to see the number of decks from people trying to raise a fund managers, that don't talk about portfolio construction, because ultimately that's what an LP is buying. We're buying not only the GP, their access, their thinking, their taste, their nose for finding great companies, but what we are literally buying by investing in the fund is actually that portfolio. And so it has to make mathematical sense. It's actually simple math. If you're going to raise $1 billion fund, you better own a lot of the company, that each company that you invest in. That's an extreme example. But, let's say if you're the typical fund that we would have is, let's say, 75 million. And, you really want to do the math to figure out what kind of exit would it take in order for one investment to return the entire fund. If you're $1 billion fund and you own 20%, it would take a $5 billion exit, right? And there aren't that many $5 billion exits. So you can do the math, and then, so that's why in our fundamental thesis is that smaller funds outperform.
And you also have a strong point of view on concentration versus a more diversified portfolio.
Yeah. So if you take that thinking about, ownership, and we're looking specifically for GPs that have higher ownership, you can't lead 100 rounds a year. You can't be from the entrepreneur's perspective, they want a partner who's going to be helping them build the company, working with them to, whether it's partnership, building out the team, helping with the product roadmap, thinking about milestones to raise the next round. All that stuff, I think, it takes a lot of time. And, there are ways to address it, perhaps, like, if you had a big platform with a number of people trying to help the companies, so it's not just the GP.
Like first round.
Yeah. But that is harder to do, and you need resources to hire all those people. But, fundamentally, because we're looking for the GPs who lead their deals, invariably and maybe intrinsically, those portfolios, it's more concentrated.
Yeah, and what is the ideal size in your opinion, or range?
Well, I'll give you some metrics just from our portfolio of all these different funds. I would say that on average, we have about 25 to 35 million of capital per partner. So a three-person firm like Freestyle, or a three-person firm like Uncork, Jeff Clavius. Those are 90 million, 100 million respectively, three partners, right? So basically, we see 25 to 35 million per partner. And then in terms of pace of investing, we see generally one new investment per partner per quarter. So to use, a single GP might have 12 to 15 companies over 3 years. A two GP firm might have 24 to 26, and three GPs might have, somewhere between 35, 37. So that's generally speaking what we see. Those could be argued. It could be argued that that's relatively concentrated.
And would you, if someone came to you and said, "Hey, we built out this incredible platform team, rivals something like our first round, and we're going to do double that because it's going to increase our chances of getting a unicorn," would you say, "Hey, I don't buy it. I'm not interested"?
Again, then you have this. It's a multivariable problem, because then you have to think about, well, what kind of ownership can they get? And if they're out there making, to use extreme examples, 100 investments, but yet they're still maybe getting 10% ownership. It's a lot of capital being deployed. The fund has to be bigger. Maybe that larger fund does have more management fees so that they can hire more platform people. So, you can see how all these different variables, all these different dials you can turn in order to get to the thing, but to get it rightly and correctly configured. But, ultimately it's about the GPs being able to be in the mix, seeing awesome deal flow, and then picking the right investment.
And so some people have the argument of, hey, if my unicorn rate is 3% or 5%, I should do as many investments as possible in ways that I don't reduce that unicorn rate, so that's that I get a percentage. I get enough shots on goal to have a chance at the unicorn.
Right.
From your perspective, does that make less sense because you have a fund of funds, you already have 100
Well, I guess from my perspective as running a Cendana Capital, we do have a number of funds and they have a number of companies. Just to give you a sense, we have over 1,300 portfolio companies from our fund managers. But, what I would argue is that, and Dave McClure at 500 and actually Jerry Newman in New York have argued that perhaps it's a larger number of companies that you would need. So Jerry actually did a pretty interesting study, which he posted on Twitter, about, how many companies one would need in order to get a certain multiple. I think his original number came out to be, close to 1,000 companies. Dave McClure also has argued that a large number of companies is the only way to actually unearth a lot of unicorns. What I would argue is that ownership, you have to overlay that into the thinking. And sure, you could invest in 1,000 companies, but investing, $100 into 1,000 companies,
right,
it's not going to generate the return. So, again, multivariable problem, lots of dials to turn. I think ownership is super important. And, ultimately we are, if you look at public market investing, there's passive and, active management, right? You have stock pickers, the rest are just ETFs, right? We're not looking for the ETF of seed investing. So we're looking for the person who can identify great entrepreneurs and to be honest, out of those 1,300 companies, 29 are actually unicorns already. And if you look at what our fund managers have done in their prior funds, overall we have 70 unicorns from our roster of managers. And I think that's a phenomenal record. Just to give you a contrast, my understanding is that YC right now is almost twice as old as us. They have a lot more companies than us, and they have less unicorns and less companies that have gone to 100 million. That said, they have Airbnb and Dropbox, so absolute dollar-wise, it's been phenomenal. But I think it's a testament to our fund managers. They picked great companies, and it's at the seed stage.
Yeah. So when we talk about multi-variables, one of the other variables is a follow-on. And if you wanted to increase ownership, some people say, well, why don't you take some of the follow-on dollars and put it for first checks and see if you're right?
Yeah. So I think, actually harkening back to your earlier question, what has sort of changed? I think generally we were starting out thinking 2-to-1 reserves. So for every dollar in the initial check, $2 for follow-on. I've actually refined my thinking around that. I think larger funds, larger seed funds can be 2-to-1. And so if you had a $75 million fund, think of it as 25 investments of $1 million. And so that's the, $25 million of initial checks, $50 million of reserves. But now we think that if you're actually below 50 million, smaller funds like 25 million, 25 to 50, maybe it's 1-to-1 reserves. And actually, if you're small, like a demo fund, if you're just starting out, want to prove the world what you can do, we think no reserves is perfectly fine. Buy the ownership up front. If you're a $10 million demo fund, buying ownership, all your ownership up front is, I think, would prove the point. It's really more about the access to the great deal flow.
And what's the argument for the 2-to-1 reserve to first check on 75 instead of just all first checks and you get double the companies and increase ownership?
Well, ultimately, these companies do need to raise additional rounds of capital. And if you're a bigger fund and you're buying, you're investing, X amount of dollars for 15%, well, to maintain that 15% in subsequent larger rounds, your pro rata is much, much larger. And so it gets to a point where a seed fund can't do its full pro rata largely at Series B. You're right. Maybe instead of 15 years, let's say 25 companies at $1 million, you're writing with 50 million reserves, you're writing 25 checks of 3 million and, just letting it run. Yeah. So what I would argue is that we actually have one, not argue, but point out, we have a fund manager, Founder Collective in Boston, which actually has a very unique point of view, in my mind, on follow-ons. And it's they simply just don't do it if the next round is above a certain level of valuation.
Yeah. And why don't more people follow that, you think?
Well, that's a good question. I think, part of having reserves is to maintain your ownership. Part of it, I think historically, and I wouldn't say seed funds should be doing this, but historically, reserves were also there to, clearly to support the company, but also somewhat defensive in that, if the company is is going sideways, maybe you have a new investor coming in that wants to put some structure on it. Maybe the existing investors do a bridge that's kind of a down run or a pay to play where you get hurt if you don't participate. So, a little bit of dry powder to protect yourself in those situations, I think was the conventional thinking. What I would point out actually is that there are very few companies who've had pay to plays or cram downs that have come out doing extremely well out of that. So our advice actually to our fund managers is if it's a structured round, if it's a pay to play, just walk away.
Yeah.
Don't put good money after bad because generally speaking, it's not really worked out.
So if more fund managers came to you with Founder Collective strategy, pushing it, most of it up front, that wouldn't be disqualifying to you? Or is it something unique about the Founder Collective team that makes that strategy work where it wouldn't for emerging?
I mean, I generally agree with that. In that, it's not disqualifying if someone came into us and said, "Hey, we're not reserving." I mean, we would want to see reserves for a variety of reasons, including defensive, plus also trying to maintain some ownership. But I think the other reality is that great entrepreneurs may not just want one VC doing the entire round at the seed stage. And so, if you're going to have to syndicate a $3 million round, and the entrepreneur wants two groups at $1.5 million, that's what it's going to be, right? Yeah. The founder has a lot of say these days, and so, and rightly so. So, I think again, it's just so many different dials that need to be turned. Generally speaking, we like reserves, and our thinking, just to put a bow on it, larger funds should be closer to 2-to-1 reserves. Smaller funds, they could have almost no reserves.
Right, and the alternative strategy to $25 $3 million checks would be like 50 $1.5 million checks, but then that gets into the problem we talked about earlier, which is founders doing too many checks.
Founders doing too many checks. That's exactly right. Yes. So if you're going to write 50 $1.5 million checks with no reserves, I think that would be hard to deploy, especially if you're going to be a lead, co-lead type of role in these companies. I mean, let's say you do that over a 3-year period. That's almost 20 companies a year, and that's almost 2 companies a month. And to lead 2 companies a month, even with 2 partners, you're still doing 12 a year, and that means you're on 12. Not technically on the board, but you're really working closely with the founders on 12 companies. And I think that's a lot.
Yeah. You see, we talked about earlier how there's been a proliferation of seed funds. How have you made sense of it as a funds in terms of filtering these managers and what you look for? Is part of it that you yourself have a portfolio where maybe you started with mostly generalists, but now there's the rise of sector specific and you're picking here's the consumer one, here's the biotech one, here's the enterprise one? How do you think about that?
Yeah, so it's a lot of different dimensions to talk about, but with our own portfolio construction, we want to be the largest LP in each one. We think, similar to a GP wanting a high level of ownership, we want to have a high level of ownership with our portfolio funds. I would say that, that one filter I mentioned, which is, does the GP have the credibility to lead their investment to get that ownership? That's been super valuable. The other one we actually use is about ecosystems. So for us, we think about it in 3 vectors: high quality founders, high quality co-investors, and a ton of local follow-on. And so, to use an extreme example, you could be the go-to seed fund in Istanbul, but they don't have larger VCs there, so they're relying on VC funds from Berlin or the continent or the UK to fly in and do the subsequent rounds. And that makes life much harder for their funds, for their portfolio companies. So, I think we started investing outside the US last year because some of the ecosystems that we've looked at have actually gotten better. London actually has now a number of new Series A funds. Berlin has a number of new Series A funds. So, I think those 2 filters, what do they have the credibility to lead the deal? And what's the ecosystem look like, including a lot of follow-on capital? If you use those 2 filters, I think you kind of self-select down to in maybe a pool of like 20, 25 fund managers worldwide.
Yeah. And have you backed any in Europe yet?
No, but we've spent a lot of time looking at it. But we've made 6 commitments actually to non-US fund managers. So Israel, Toronto, 3 now in China, wow. 1 in Australia, and we're planning. We have 1 in India and planning to do another in India.
What sectors have you done specific?
Yeah, I mean, you're right in that back in the day, most of these firms were generalists, right? So, and I think I've made a comment in an interview that I thought that, it's actually harder to be a generalist now because you have the incumbents, meaning that if you want to start your own new firm, saying that you're going to be a generalist, that means you're going to be competing against, people like Jeff Clavier or the Larry Hippo team or whomever. And, I think to be more thematic is you really need to position yourself in the market and to be able to answer how am I going to beat that person out on a term sheet. Now, granted, most people are coming in and saying, hey, we're just going to syndicate with those guys. We're just going to be part of the round. But I think if you're going to be the thought leader and, being able to compete with the groups that are leading their investments, you really have to be either someone who's super credible, maybe coming out of a bigger Sand Hill Road firm with a great track record, or amazing domain expertise or an amazing network. So, we funded a group called Wave Capital. Riley Newman was employee 7 at Airbnb. He ran their data sciences team. Someone who's very credible within that firm. And so that kind of network at Airbnb we viewed as having substantial value. We'll see how it plays out, but that's an example where someone who may not have had a deep investment experience or track record, but brings something very valuable to the table.
Did you guys do Forerunner?
Yes. So with Forerunner, we were the first to commit to them. And so in their first fund at 40, I think Kirsten's first fund was like 41 million. We were 10 million of that. In our second fund, we were 20 million of it. And our second fund, I believe, was 75 million or so.
Yeah.
That's an example of someone who has tremendous domain expertise. She started off with like a demo fund. A friend of hers had given her a small pool of capital. She started deploying it. And as part of her diligence, we would call the CEOs of those companies and say, we're looking at Kirsten's fund. We know that she wrote you a small check, but what do you think of her? And, almost all the CEOs said, Kirsten's so amazing. She knows more than most of our investors. She's our first call. And, if she had a $40 million fund, of course we would have let her lead the seed round. So that's actually, I think, a good playbook for someone who's looking to raise a fund. Start off with a demo fund and be close and be very helpful to the CEOs that you back. You don't need a $40 million first fund. A number of our fund managers, like the Freestyle guys, for example, all started off with small funds. Manu Kumar, $6 million fund, right? If we're not invested with Chris Sacca, but his first fund was $8 million, right? Yeah. And so I think you really just want to be able to show that you can have access and also add a lot of value to the portfolio CEOs.
Yeah. And do you get involved in demo funds, or when is the earliest you get involved, or what's like the smallest fund size you'll be a part of? It makes sense.
Yeah. I think the smallest fund that we committed to was 12 million. It was Mucker's first fund. And, Mucker Capital in LA has done an amazing job. I mean, they have 2 funds that are in the top 5 percentile. These are generating major returns and have distributed major amounts of capital.
Yeah. Let's say, you're backing a fund and they, fund 1, fund 2, 75, maybe 100, and then it goes up to, 300, 400, and they're on their way to being the next Andreessen. My understanding is that you tend not to participate then.
Right.
Is it just, hey, your fund size is your strategy and you don't believe that bigger funds will make money, or how do you think about that? Does it make as much money?
I mean, Sequoia's funds are relatively large compared to what we look at, and they make a huge amount of money. So it's not so much that, it's just our strategy is focused on seed, and our LPs only want seed. Our LPs can probably get access to the larger funds, and so they don't need us to try to access the sub 100 million. So generally speaking, it's not in our LP agreement, but generally speaking, we look for funds under 100 million in size. And it's because at the seed stage, if we're looking for someone who's leading their investments, again, you can't have a whole bunch of companies, and the round sizes are a certain amount, and our fund managers are writing X percent. Yeah. That just, on a bottoms-up analysis, comes out to roughly about 100 million.
Yeah. So you did Forerunners consumer. What other thematic funds have you backed? I'm curious how you viewed emerging categories like crypto and longevity.
Yes. It's interesting because a lot of this has come in waves. So actually, blockchain and crypto, we saw a number of those funds, in fact, like 3 or 4 or 5 years ago. We just thought it was way too early. So I personally invested in funds like Blockchain Capital, Brad and Bart Stevens. We don't do biotech, but, Laura Deming at Longevity Fund, she had a very interesting thesis. She's an amazing person. So again, I invested personally, and Longevity wasn't a seed fund. They're largely focused on Series A, but the financing dynamics in biotech is completely different, right? Their Series A might be $100 million, and so going back to the wave thing, what I would say is that we saw a wave of blockchain funds, we saw a wave of AR/VR funds, a wave of IoT, connected home, connected device. We even saw a couple funds focused specifically on cars and trucks. So we see that, and I think back to my earlier point, it makes sense for people who have that domain expertise to go after and position themselves in the market. The real problem is, are you too early, or have you defined yourself too narrowly? And so generally speaking, we've not invested in those funds. And, I think in 2017, just to pick on blockchain, people were piling in. You get in all these different groups, some of the more hedge fund-like ones, the equity ones, buying tokens. And, by end of 2018, people were pretty bummed out. It's good that it's kind of recovered, and maybe the long-term arc is that it's going to be super valuable. Maybe it is the next sort of TCP/IP, but, we don't know that. And if you look at the adoption of different dApps, it's pretty low.
Right. Some people say that YC has sort of an unfair advantage where they are the best structural business model where they have high ownership and very wide portfolio. In your model, would you have missed something like YC or not have done something like YC? Or what's been your thoughts on the rise of YC or the rise of accelerators generally?
I think clearly YC is the most dominant, and rightly so, in terms of the accelerators. And it's a great business model. They're getting 6+% for actually a very small check. I wonder about their portfolios because, their class sizes have increased materially. I would say that AngelPad is also a very, very respected accelerator. But, taking a step back, we actually don't invest in accelerators. And, we're close to a number of them, but I would say that there is a worrisome thing for us is adverse selection. And, generally a second or third time seasoned entrepreneur can go out and raise their own round without having to go through an accelerator. I would say that most of the accelerators have younger founders or first-time founders. There's nothing wrong with that, and they've identified some great ones. But generally speaking, I just kind of wonder, if you're a great entrepreneur with a great opportunity, you should be able to go out there and raise a round from either a seed fund or the best entrepreneurs can just probably go to Sequoia and raise a $10 million Series A right off the bat.
Do you have that same fear as it relates to things like Atomic or Expo or Science or incubators?
Those groups have all come up with some amazing companies. There's no doubt about that. And, I would say that being able to create amazing companies every year in, year out would be kind of an amazing feat. And I'm not sure that they can do that, but, they've had tremendous success. And, I think a lot of our fund managers are actually pursuing group companies coming out of there. And so, but the fact is, the world is a big place. The market forces are important. And, Leonardo da Vinci came up with a whole bunch of different ideas. I'm not saying that the Expo guys or the Atomic guys are not Leonardo, but, to be able to come up with amazing ideas consistently and also create an environment where you're fostering that is hard, because also if you're an entrepreneur and you're going to an incubator, I don't know what those guys take specifically, but generally speaking, incubators take a really healthy cut of your company.
Yeah.
50, 60, 70%.
Yeah. What has been the most innovative seed fund since first round? When they came out the platform, what have been some of the waves of innovation on first round seed?
Well, let me just think about this. What I would say is that, as an innovation, I think the seed funds have come up with this idea of an opportunity fund. And so for us, we're actually kind of happy that they did that because, someone like Jeff Clavier, he can go out and raise a $200, $300 million fund. But, he wants to have his seed fund a certain size, and then the opportunity fund is another size. And so, in a way, that innovation, which I think came out of having to do, not necessarily for Jeff, but, seed fund managers doing SPVs, and it's a pain in the ass to do an SPV and to track them and to also, just deal dynamic. You're going to the founder saying, hey, can you give me a $5 million allocation? And then on the other hand, you're going to your LP saying, hey, I got a $5 million allocation. Can we fill the SPV? And oftentimes, or sometimes when you can't, it creates a lot of friction. So, I think the opportunity fund idea was a pretty good innovation. But, I think the platform and the services, that sort of mentality is at a high level really good because, you're really putting the burden on the VC to provide service to the founder. And ultimately, that is what you want to see in a venture capital firm, in that they're not just providing the cash. Now, of course, there's the benchmark example where they invested in eBay. eBay never even touched the money. They went public. It was a phenomenal returns for Benchmark and their investors. So you can always point to things like that And, it is often very profitable to be lucky. But, I think being able to identify great entrepreneurs, being able to help them, the whole service mentality, it's a mixed bag, but I think the trend is generally a good thing.
Yeah.
So that's it, opportunity funds and platforms, trying to be able to help. Otherwise, most of the seed funds, they don't have that much management fee. They're not creating some special sauce in order to do what they do. You could point to sort of early stage firms. I wouldn't call them a seed fund, but like, Signal Fire, Chris Farmer, he has this amazing database that everybody in the world wants to get. So that might create some innovation around finding signal out of all that noise.
Yeah. How have you viewed the rise of scout programs and its effect on venture? What are your thoughts on it?
Well, starting at the high level, I would say that, a number of the Sand Hill Road crowd have been pretty active. They've been active into seed stage, but then a number of them pulled back because, they were doing it more as call options, being able to see what was coming up. And they were getting some blowback. To just use an example, if Excel didn't lead the Series A of a company that they'd put in a little bit in the seed, then, that'd be a negative signal. And I just mentioned Excel because it's a very important firm, and it does send a signal if they're not participating or leading the round. So, I think the bigger firms realize that they're getting some reputational hit by doing a lot of seed investing, not necessarily knowing the companies or the founders, and then not coming through with the Series A. The founders are getting upset about that. So I think, the way Sequoia did it is actually pretty smart, to have their sort of friendly network of people actively looking out on their behalf. And, that's ultimately, what you want to do. It's almost like fishing. You want to cast your net wide, but you got to know where to cast it, right? And then you have to be able to hook a fish, and then thirdly, you got to bring them in. And so I think with the scout programs, to use that fishing analogy, it's just casting a wider net. But Sequoia kind of knows where they want to fish, and right. So it's an enhancement, but it's not a replacement for what they do.
Yes, but Sequoia has also spun out, and a number of other people have spun out sort of independent funds that are focused on this. Do you think that those funds can return well? There's scout funds by themselves as opposed to just flow for the A.
I mean, so just to keep on the topic of Sequoia itself, they are very close to a number of early stage investors, and individuals as well as funds, and not just in the U.S. in the other geographies that they're in. And so I think those serve to be really good onboarding paths for entrepreneurs to start working with Sequoia. And Sequoia covers the full stack, right? I mean, they have the scouts, they have their seed program, they have their early stage venture, and they have their growth. So, they can continue on. And, to use an extreme example, WhatsApp is a great example of where Sequoia kept it all under one roof, right? And they reap tremendous alpha in return for that. I think looking at our portfolio, our guys and gals, clearly want to have tight relationships with the downstream capital. And so what they do is our fund managers typically spend time with the larger funds, perhaps every quarter going through their portfolio. Maybe it's not even as formal as sitting in a conference room and going name by name, but, they talk to the different partners. And of course, each partner at a bigger firm, they really have their own sort of areas of focus. And it's the job of our fund managers to know that that person in that firm wants to have these kind of deals. And, just being able to know that is super important. So scouts, they're important clearly to firms like Sequoia and the like. But from our point of view, our portfolio fund point of view, it's important for them to have strong relationships with the Sequoias and benchmarks of the world.
If you look at a firm like Thrive, I think I don't know if their first firm was 10 or 40. It's pretty small. And now it's like...
Yeah, I met with Josh back in the day. Yep.
Yeah. And so I'm curious why there aren't more firms that start out small, but that say, hey, we want to be the next Sequoia, but we're going to start small and then work our way up. Most funds, it seems, tend to, maybe not as much as their obviously like, but stick, first round, I'm doing this same thing for a while. Like, they could expand if they wanted to. USV, I mean, a lot, even Jeff Clavier, perhaps, a lot of these firms could go a lot bigger.
Well, just to use some names, you mentioned Forerunner, and we were invested with them in Fund 1 and 2, but then, Kirsten she started raising larger funds, and to her credit, even from day one, she was saying that she's not sure that seed is the right entry point for the companies that she's going after, the spaces that she goes after. So that's totally fair, and you may need to have more capital in order to maintain your ownership, and it may take a longer time. In the case of Thrive, I think Josh is a very unique person. His network is very unique, and he has an extremely good nose at finding great opportunities and is not afraid to write big checks against that. And so, he clearly has done very, very, very well. I know that when I first met with him, I think he had a small pool of capital from General Catalyst or some friends, and then he raised like a 40-plus kind of $1 million fund. But even then, he was saying that he wanted to have a larger fund to be able to go after opportunities across the sort of the spectrum, not just C, not just A. So, he was just thinking about it as in terms of sort of a bigger opportunity set. And you could argue that like Tiger Global thinks that way too, but then they started moving down earlier. So they were starting to do Series A's, for example, notwithstanding that their fund is really big. So, I think it depends clearly on the person. The fund managers that we work with, we spend a lot of time understanding their motivations and what they want to get out of life. And, I think we're pretty convinced by the time we make a commitment that the groups that we work with want to stay small. Yeah. I mean, I'll give you a really extreme example. There's a fund manager in China that we know quite well. First fund was 32 million, 10x. Second fund was 37 million. Believe it or not, it was a 30x.
Oh my God.
That group returned $1.3 billion in cash.
Wow.
Now, in China, they all want to get big. These guys have have made a lot of money just from the carry on $1.3 billion. But, their next fund is $50 million, and they want to be small, and they want to be work. They think that's the right number to be early stage for in the markets that they're pursuing. So, that kind of discipline is actually very admirable, and probably easier to say that you're going to do that than actually do it, because you see this sort of inflation in fund size. But I would argue that, at least with our fund managers, all but two have stayed at the seed stage. They've all gotten a little bit bigger, but it's largely because the round sizes have gotten bigger.
Yeah. I'm curious why there hasn't been something like a YC, but for fund managers, something that takes all the people who are emerging managers, aspiring managers out there, building their demo funds, and takes some economics in it in addition to some capital, and has the mini YC.
Yeah, I've been batting around this idea. This is somewhat a similar idea with some of my LP friends, and what it is. So one idea was, why don't we focus on these nano funds, these sub $15 million funds, maybe like these $5 to $10 million funds. There are a lot of studies that show the first fund is actually the best fund in terms of performance, but I think it's partly because it's so tiny typically. But why not have a roster of small, tiny funds, and that we would, maybe, get them. It'd be like YC. We would get them going, train them, thinking about portfolio construction, about all the different angles. But ultimately, what I realized is that unlike YC, where they have a whole bunch of VC funds that actually lead the next round, in the institutional LP world, if we didn't, and we meaning collectively the group that, let's say I assembled and came in and did a YC for C funds, these nano funds, if we didn't follow on, if we didn't do the next fund, we basically kill that group. Yeah. So we don't want to be in a position of doing that. And so I think our job is actually to find, whether be flexible enough that we could invest in a $5 million fund, and maybe that'll be a 50x, and that would be a great return.
Yeah. In the next 5 to 10 years, how do you expect your job to be different, or even just the seed ecosystem to change over time? We talked about some small changes. We talked about some bigger attempts that people are making with new models and using data and different types of things. But what do you expect to change?
I think that historically our fund managers have been from the Bay Area, New York, and maybe a little bit in Boston and LA. And what we're hearing from our fund managers and what we see every day almost is that, they historically would say, yeah, we're backing only firms in our companies in our own backyard. But we're actually seeing more and more dispersion now. So funds that are based in San Francisco are investing in companies in Chicago, Atlanta, Austin, Boulder. And I think it's partly because it's very expensive to be living here in San Francisco. And so, the CEO might be here, but her dev team might actually be in Austin or Boulder. And so I think that's a perfectly rational thing that's happening in the market. I think also that, outside the U.S., you're seeing a lot more early stage formation and entrepreneurs actually proliferating. I mean, think about where Germany was, historically, where graduates of the universities would go into big companies. And now that's not the case. It's a lot more entrepreneurial. And I think starting in the 90s and, especially in the 2000s, people, even like something as silly as that Facebook movie, I think a lot more kids are seeing entrepreneurs as being sort of the heroes. What was kind of disturbing, though, is that there's this backlash, clearly, right now against the big tech companies, whether it's for becoming a platform that enables this, that, or the other thing, or censoring, or, generally influencing how the world thinks. And perhaps some people don't like that. And so, a number of people across the aisles have been talking about perhaps breaking them up. And so, I think that's the first time you really have this backlash against technology. And, it's partly because, what it is? It's the fact that everyone has a smartphone. They have a computer in their hand. And, in developing countries, they basically skip out, forget about laying out cable and telephone lines. You go straight to wireless. And you can bypass that huge infrastructure cost and basically get everybody online. Like last year, I took my family to Africa. Generally the villages kind of look the same, but everyone had a smartphone. And M-Pesa, which is the mobile payment thing in Africa, everyone had that and used it. So, I think just because so many people are more connected and being able to execute online, commerce or whatever, or certainly communications, technology is super pervasive. It's reflected in the top 10 largest companies by market cap, etc. You see it everywhere, and I think there's this backlash. And so in 5 to 10 years, I think, you really got to wonder how the role of government and how they are going to, impact, whether positively or negative, probably negatively, the larger tech companies.
Yeah. And could you see yourself backing a manager in Africa?
Yeah, absolutely. I mean, we met with a number of them. I wouldn't say there's a whole bunch of them, but the biggest issue for those guys and gals is that they need follow-on capital, and there's not much follow-on capital.
Yeah.
So their funds have to be a little bit larger so that they can keep the companies alive, and then maybe they can attract a firm from Europe or the U.S.
Can you SoftBank just put in all this money into LATAM? Right. Could you see yourself?
Oh yeah, I mean, we've been from the get-go looking at different seed funds in Latin America. Again, it's the lack of follow-on capital. There's a great firm in Brazil called Kazakh, and we started talking to those guys for their first fund. And they were two of the co-founders of Mercado Libre. They went to Stanford GSB. They're actually Argentine, but most of their investments are in Brazil. They've done a tremendous job, but and it was looking really good when Axel, Peter Thiel, Thrive Capital, Andreessen, they were all looking to do follow-ons, but that kind of dried up actually to some extent, and then certainly their currency got devalued, and the political turmoil has created somewhat of an issue intrinsic to localized to Brazil. But I think generally speaking, if you take a wider arc timeline, the trend is your friend. Indonesia is one of the largest countries in the world, and to have every one of them on, conducting commerce on smartphones is an amazing thing. India, China, they're all huge, and the fact that a startup in China can go to 200, 300 million of revenue in a year is remarkable. And they have companies that haven't been around for more than 5 years that are now public in the U.S. stock exchanges that have $20 billion market caps.
Yeah.
You could argue, on the other hand, that they're way overvalued, but it's just remarkable. I mean, if you even in the U.S., you look at a company like Hims or Romans or any of those type of companies, they largely have gotten to 9-figure revenue amounts in 1 year.
Wow. In the last 10 to 15 years, you've seen the venture ecosystem become a lot more transparent. The composition is a little bit changed in that there's a lot more founders becoming VCs. It seems to skew a little bit younger, but it's certainly a lot more transparent, founder-friendly. I'm curious if you're going to see a change in the LP ecosystem in the next decade, becoming more transparent, more diversified, perhaps.
What I would say is that it really comes down to like motivations. If you're at a blue chip university endowment, you're proud of the work that you do, the access that you have, but probably the portfolio you're working on has already been built up. And so you got to find that one or two new stars. And venture is not even really an asset class. With public market equities, you can plenty of groups that are doing mid cap value U.S. equities, and they all standard deviation within one or two little tiny bands of that. But in venture, the standard deviation, meaning the spread of I think the performance and the risk is very broad, and I don't think you can just say, hey, I'm going to devote 10% of my portfolio of my endowment to venture, because if you're not in the best firms, or at least the ones that look like they're going to be emergingly the best firms, then you shouldn't be in it. In fact, you should be in small buyout because you can get a 2x faster with less risk. But what you see is, because of quantitative easing, a huge amount of capital since 2008 coming into the private markets. The public equities have really grown, obviously, and because of that, and because groups have allocations to private markets, that has pulled up, right? And so, if you're a $10 billion group and suddenly now you're a $40 billion group, and you have a certain amount allocated to private markets, you're putting more into these funds. That's why VC funds have gotten bigger. That's why you see seed funds proliferating. I think, generally speaking, I think it really depends on the type of LP. University endowments are historically considered at the top of the food chain because they have perpetual capital. They're not fundraising. Groups like mine are kind of at the bottom because we have to fundraise ourselves, so we're not stable capital, or so they say. Family offices have become much, much larger. I would argue a lot of family offices are very sophisticated in terms of what they look at. And so, there's just simply a lot more capital deployed. Sovereign wealth funds, hedge funds, they're all getting into venture. And that's, on the one hand, absolutely terrible for startups and early stage investors in that, to use an example, SoftBank Vision Fund coming in and giving a startup $500 million, that may not be the best thing for them because they might not have figured out their unit economics, right? And it makes perhaps the CEO a little bit less disciplined in terms of getting the company to, basically cash flow positive unit economics. On the other hand, it's been great for our seed fund managers. And I'll tell you why. Our managers are doing a lot of secondaries now. So when the company crosses that $1 billion mark, when they become a unicorn, in that round, our fund managers are actually trying to sell 20, 30% of their position. And, we've seen a lot more of that just in the last 6 months.
Do you think we're in for a reckoning in the next few years? Whether it's to valuations coming down or a ton of seed funds just being washed out?
There's been resets, certainly. So, like, if you remember in the Q1 of 2016, LinkedIn actually fell. They lost half their value in one day. And that was kind of a major reset of enterprise multiples, from 8x to down to 4x. They've kind of climbed back, but in our minds, that was actually a positive thing because there's a major disconnect between public market and private market valuations. And, again, not to pick on anybody, but like Dropbox is raised at $10 billion back then, and Box went public at about $2 billion. And, if you looked at the different revenue multiples, there was a disconnect. And so, I think Dropbox, and it's been publicly stated, basically had to buckle down, cut costs, get their unit economics right, and then get them in a position where they could go public, right? That took some time, and I think that was probably better for the company in order to go through that discipline, go through that transformation. And so, clearly, the stock market's not just going to keep going up. I mean, obviously, there's going to be some sort of material downturn. Whether that's in a year or 5 years or 10 years, I don't know, and I'm not going to try to predict it. But what I can say is that I think our seed guys and gals are really well positioned because there is a lot of later stage committed capital from sovereign wealth funds, from the hedge funds, from the big growth funds, to even the Sand Hill Road funds that are all $1 billion in size now. There's a lot of late stage capital. And I think good companies get funded no matter what. So if you look at post the Lehman bankruptcy in 2008, September 08, within 9 months, Uber, Lyft, Airbnb, Slack, Pinterest, those companies were formed within the next 9 to 12 months. And those were the dark days, if you remember. So, I don't think you can time technology, and as long as there's capital out there, and that capital might be harder to pry out of people's hands, but I think at the seed stage, our fund managers can sell for relatively low valuations and still get their money back.
Yeah. Is there what AngelList has done, among other things, is expand the amount of people that can be angels. People can raise funds, people build profiles, founders can find them easier. Do you think something will exist at that sort of scale in the LP world, where there will be newer LPs, it'll be easier to become a micro LP, and it will become, it all have profiles, here are all their funds, because right now it's sort of a...
Yeah, I think, so you just philosophically, you got to wonder about adverse selection. So if something is on AngelList, and I'm not picking on AngelList in the ball, but if something is on AngelList, you got to wonder, well, how come they didn't raise the whole thing through, Mike Maples or Steve Anderson or one of our fund managers? So then, you got to wonder, why am I being shown this? I think every individual investor, as well as any institutional investor, has to be thinking, why am I being shown this, right? And so, you could argue that with on the LP side, the funds are bigger, the timing of the raises is longer, right? Like some of the hot companies in the startup world go for in a week, right? But generally speaking, funds don't go in a week unless you're like Sequoia or Benchmark. And so there is time to think about it. But I think, if you're not in a major hub of venture, it's a little bit more difficult to actually know what's better. Is A better than B, or is B a little bit better than C? Who the average person probably wouldn't know. I'm not saying I would know, but to your point, the world is becoming a lot more transparent. The LP world, especially. And I think people generally know what we look for. We look for groups that lead their deals in ecosystems that have a lot of follow-on capital. If any investor took that playbook, they could actually do a pretty good job, I think, of finding very good seed funds. And, more power to them.
Yeah. Have you done any university funds, or do you find that space interesting?
We've spent time looking at groups that try to commercialize university research. And I think there's some amazing things coming out of the different universities. But generally speaking, the teams that are around those technologies may not be the teams that can scale the company, right? Because they may be the guy or the gal who actually discovered or created or invented, some sort of technology or process. But that might be their amazing superpower, but it's maybe not likely that superpower is to build a company around it. So then you have the additional complexity of finding a team to help take that to the next level. So I would say that there are funds who do this, and some of them have been pretty successful. But I think in general, it's an extremely hard thing to do. And then the other element is they're not necessarily capital efficient. So you might come up with a great process for semiconductor making, but that's not really a seed-funded kind of opportunity set.
Yeah, makes sense. What last advice would you give out there for people who are looking to create demo funds or looking to learn from the wisdom of your emerging managers?
So when I raised my first fund, it took me 2 years, and so now people are like, oh, it must be so easy for you to raise a fund. And the way I answer that is, when I first started, 99.9% of the people I pitched said no, and now 99% say no. And so it's really a question of, and there's no real right or wrong answer about it, but it's perseverance, grit, and determination, and an optimism that what you want to do is actually going to be right. But at some point, if you're not getting any traction, you got to stop and pursue something else, I think. Yeah. Fortunately for us, there was some early product market fit, and now there's pretty good product market fit. But, the other thing that I would warn first-time fund managers that, you don't want to spend 3 years trying to raise a fund. if you can raise 2 to 4 million and you can kind of get by, on a sort of ramen kind of budget, go out and do what Kirsten did, which was phenomenal. Invest in a portfolio of companies, have those CEOs take reference calls and say you're an amazing investor, and then you're off to the races.
My guest today has been Michael Kim of Cendana Capital. Michael, thank you for coming on the podcast.
Thanks.
If you're an early stage entrepreneur, we'd love to hear from you. Please hit us up at villageglobal.vc/network catalyst.